Hello there, you're watching Africa Business Weekly, where we take you on a journey across sub-Saharan Africa and bring you some of the most impactful business stories this week. I am David Alabi. Now, from the lifting of a 10-year ban on GMO crops in East Africa to improve private equity and venture capital funding in West Africa, we will start by setting our sights on South Africa first, and then Tanya takes us through some of the key stories in Southern Africa this week. Take it away, Tanya.
Thanks, David. And for market-moving stories from south of the African continent, we begin with a short recap from our latest Power Table, where we hosted two global bank economists about the state of Africa's debt distress. CNBC Africa's Fifi Peters spoke to Tatonga Rusike, sub-Saharan Africa economist at the Bank of America Global Research, and this is what he had to say.
Africa as a whole is not in a debt crisis. There are some countries that are facing strains and probably in high risk of debt distress. We actually have some good stories that are coming out of, let's say, Angola to some extent, South Africa to some extent, as well as far as debt is concerned. Then the World Bank talks about 14 countries that are in high risk of debt distress and 8 already in debt distress. But when you look at the bigger picture, at least for the multilaterals like World Bank, IMF, they're also including a lot of non-market access countries. So you've got a lot of, I think, other, we would say, small countries that don't actively access the markets. So these already have high debt stocks, well, over 100% of GDP. So then when you come to the second layer now, that's where we can actually debate where we've got market access countries that have got, yes, high debt, but some of it is not necessarily a debt stock problem, but it is a financing problem. A financing problem, especially with global conditions that global central banks have been raising rates quite aggressively. So countries have been shut out. You have Ghana that was shut out since last year, Kenya, Nigeria, and many others. I think right now the conditions are just difficult for anybody to access. So the financing is coming from a globally driven issue. And then secondly is, I think, domestic as well, where you've got inflation everywhere and central banks in the domestic markets are also raising rates. So it becomes difficult for countries to borrow within the domestic markets. You've got central banks in Ghana, in Nigeria, stepping in to help the government financing. But broadly speaking, I think most countries on the continent are actually financing domestically fairly enough, despite the rising domestic interest rates. The challenge is the global story, which speaks to the Eurobond market that countries are not able to access. So I think that's probably where the starting point is. But right now, you would say that we don't have a lot of Eurobond maturities coming due, be it for the remainder of the year or into 2023. And therefore, you don't really expect to see defaults. But there's a case to be made for some countries to consider restructuring. I think we've got Zambia already in the process of doing so. We've got Ethiopia, which has asked for common framework, similarly to Chad. And Ghana is asking for a program with the IMF, which could involve some discussions around restructuring.
And then in more continent-wide economic concerns, I spoke to the World Bank's Africa economist Andrew Dabalin about their latest Africa Pulse report. The bank is expecting decelerated growth in the region, and he explained the concerns contributing to this.
So I think right now what the countries are doing is, the most important thing the countries are doing right now is to bring inflation under control. It's really important to bring price stability back, because the surest way of actually increasing the ranks of the poor is if inflation goes unchecked for long periods of time. So that's one important thing. And that is a major role for the central banks, which are raising interest rates in order to be able to actually meet that challenge. The second thing that the countries are doing is to think very seriously about protecting the gains that they have made. This is in particular trying to make sure that they protect the poor and the vulnerable households, making sure that the programs that support these families are actually funded fully and potentially expanded. And the third thing that these countries are doing is, of course, to try and increase production so that they can reduce this huge gap between demand for goods and the supply that is fueling part of the inflation that we see in the region. So those are some of the things that the countries are doing.
Absolutely, and particularly when it comes to inflation, when you think of the poorest communities, they are actually the ones that are hit the most, when up to 40% of a family's budget can go on food. Inflation is really hurting them the most. So what is the World Bank doing in this respect in terms of action to help African nations that are struggling with this?
Yeah, thank you for asking that question. So what the World Bank is doing is the following. For the period for the 15-month period leading up to June 2023, what the World Bank is doing is putting $170 billion in play for the countries to be able to meet their development objectives around adaptation to climate, meeting food security needs, and also the other objectives that they have, such as financing education, health, water and sanitation, and so on and so on. So that is the most immediate thing that the World Bank is doing in order to actually support this country's cope with this massive challenge. The second thing the World Bank is doing is, of course, to really advocate on behalf of these countries for some form of debt relief. So what we're doing, during the pandemic, there was an initiative to suspend debt service for 48 countries, and that delivered billions of dollars that were then, that were diverted to key development needs at the time. But now, that has come to an end, December 2021. Since then, we've had a war. There's inflation that is raging. There's, food security crisis, and so the debt levels are rising, and the vulnerabilities for a full-blown financial crisis are real for some countries. So what the World Bank is doing is to basically get behind a common framework for debt treatment that the G20 countries have proposed that will have a longer-term solution for debt suspension, debt resolution, and debt reduction going forward.
And that's all from me. Back to you, David.
Thank you so much, Tanya. Let's now move to East Africa as Fiona takes us through stories that also shaped the headlines this week.
Thanks, David. From East Africa this week, the Dar es Salaam Stock Exchange closed the month of September on a low as all benchmark indices closed in the red. The All Share Index shared about 36.93 points and the Tanzania Share Index trimmed 50.66 points. Here's a conversation we had with Ami Julian, investment and research analyst at Orbit Securities.
The biggest reason behind this drop in points, this shedding in points, was largely driven by huge sell-offs among investors. We had huge local investors exiting, but also foreign investors, as if you have noticed that we are facing a lot of geopolitical uncertainties, especially at a global level, but also after economies were recovering from the pandemic, we have seen as soon as we wanted to settle, the Russia-Ukraine turmoil just came up, and with that, it made investors kind of worrisome, especially in investing in frontier markets or emerging markets at large, specifically the Dar es Salaam Stock Exchange. So we've seen investors moving their positions, closing up their positions, but as well investors selling off. But also, here in the Dar es Salaam Stock Exchange, there is a seasonal trend, and most investors, especially the local ones, are dividend-driven. With that being said, we had a high peak season from January till August. And during August is the peak season where most companies finish up paying their dividends. So moving forward, investors usually start exiting their positions. So first, because it's a dividend paying off season. But second, investors are also securing their profits. So it's a sell-off always tends to occur during September month. And if you have noticed, even in the S&P 500 index in the US, during September is always a downturn month also as well. So it's kind of a cold month in the exchange for sure.
I mean, in terms of numbers, what do the numbers show in terms of sell-off, whether it's for local investors but also foreign investors?
Okay. So we see that for first, as much as the market, both indices shared points, we also noticed that the turnover was actually higher compared to August. We see the turnover was at Tanzanian shilling 18.16 billion, which is 14% higher than the 16.2 billion actualized in August. But with our local investors, we saw that local investors actually dominated foreign investor participation by large, almost more than 56% of all the buying activities and more than 90% of all the selling activities. So this actually confirms our hypothesis, or confirms my earlier statement that this sell-off is driven by local investors who are exiting their positions upon being paid dividends, but also securing their profits. Because, you know, the Dar es Salaam Stock Exchange during this year, it has been among the top 5 performing stock exchanges in Africa. And also we had a huge rally actually from January until August, where we saw some companies quite perform well. For instance, Swissport had almost an 84% increase in share price, so bringing huge profits for investors. So with that being said, and with such a rally, we saw that investors are now actually securing their profits because there've been a huge buying trend. So now we are moving towards a selling trend. So, and that is what happened in September actually.
I mean, I'll ask you more. I'm still interested more to understand the foreign investor appetite at the DSA. But before getting there, could the same reasons you just mentioned explain the downward trend we saw in the market cap at DSA?
Yeah, that could be one can explain that. That's one of the drivers for that, because, you know, whenever there is a huge sell-off, that means supply exceeds demand, and when supply exceeds demand, there is always a fall in share prices. So we saw several stocks actually shading their share prices. Actually, most of the liquid stocks shed their share prices. We saw like the likes of NMB closing 3.4% down, the likes of CRDB closing 4.9% down, the likes of Tanga Cement actually closing 14% down. So with such sell-offs, supply exceeds demand, and with that, share prices always fall. And that is what actually led to the indices shading off points, but also the market cap declining actually.
Also from the region, Kenyan President William Ruto's government has authorized the cultivation and importation of genetically modified crops and animal feeds, bringing an end to a 10-year ban. The decision is meant to address the current food shortage in Kenya. For more, we spoke to Jason Brangaza, the Executive Director of the African Forum and Network on Debt and Development.
It's quite significant, rolling back a 10-year ban that had initially been brought into place following some very significant health warnings in reference to how GMO products and GMO practices were likely to impact the health of not just farmers, but also consumers and Kenyan citizens at large with regard to how food cropping and food produce is going to be done in the country. And so this announcement earlier this week by His Excellency William Ruto is quite significant in terms of rolling it back. With regard to the motive behind it and whether this is likely to have a significant impact on food production and the food insecurity that we are currently facing, we are yet to see. But certainly there is still some significant reservation with regard to this announcement that was made earlier this week.
Have said this ban was imposed, if I'm not wrong, in 2012, and there were a lot of health concerns around it. Now, these health concerns seem to have been overlooked by the government when they made this decision. What's your view on this?
I think it's important to look at things in context. We certainly hope 10 years is a very long time. And certainly we hope that the science behind what has informed this decision has also been updated to take into account any advancements in the GMO practices, the GMO methods of farming, but also the science behind the potential health impacts that GMO farming is likely to have on farmers and on Kenyan citizens. We cannot disregard that this is still a major factor, and it does have a major negative impact on mass production of using GMO methods. And this is not something that is only unique just to Kenya or to Africa. This is a concern that is shared globally and internationally with regard to how GMO inputs are utilized in food production, especially. And so there is a lot more that needs to be internalized with regard to how this final decision was actually arrived at, and the extent to which health considerations of Kenyans was put at the center of this decision.
And as you've said, it is not unique to Kenya. It is GMOs are, it's a global issue, and the health concerns still remain. So how do countries that have already gone the GMO way, how do they handle the health question?
I think it's important to notice whether there's a hybrid way of doing food production, particularly in developing regions like in Kenya. The GMO direction has been one that has been externalized to domestic policy making, and one that has been advanced really by a lot of international financial institutions and international organizations that are propped up or financed by big multinational corporations that are involved in the GMO business. And so one needs to take that into account and have a look at really what is really behind this push towards the GMO. The second point really is to look at, and this is the hybrid that I'm talking about with regard to domestic policy making, is to look at how the agricultural sector on the continent generally, and in Kenya more specifically, is being financed. Here in Kenya, the allocation from the budget from the national treasury is just under 3% to the agricultural sector, and so it is no wonder that we find ourselves in this very precarious situation where the food production and the investment in food production in the country is very low, and is then requiring us to look at these alternatives. So I think we have to also, try and balance these two things and look at it from a very critical domestic point of view as well.
These are some of the unique stories from East Africa this week.
Thanks a lot, Fiona. Now, from West Africa this week, Africa's private equity and venture capital ecosystem recorded one of the strongest half-year results to date, with the private capital investment pulling a cumulative deal value of $4.7 billion, while the cumulative value of venture capital deals grew 133% to hit $3.5 billion and is on track to reach about $7 billion by the close of this year. Nadia Coulibaly, head of research at African Private Equity and Venture Capital Association, broke down the key drivers of the half-year performance.
So with the general sentiment on economic condition continues to be downbeat with the revised and feeble growth, also with high inflation, geopolitical instability, and also depreciation of several African currencies among the top concern, Africa Private Capital Industries has shown promise for the year ahead, in particular with the deal-making and exit activity. Concerning the private capital investment in the continent over the last half year, we've seen a total deal value of 338 deals with a cumulative deal value of $4.7 billion, which is one of the strongest year of the private capital activity ever recorded in the industry. So what are the main drivers? How can we explain this strong activity in this tense economic climate? So we can identify clearly three main factors that have contributed to the surge in the deal making. So the first one is the substantial amount of fresh capital raised last year by fund manager, along with the capital that was put on hold during the pandemic that have been deployed this year. The second reason is the increasing interest also in the Africa venture ecosystem, which has not only attracted international investors and supported the development of domestic venture capital firm, but it has also encouraged traditional Pan-African private equity firms to broaden their strategy to include a dedicated focus on the venture capital. And finally, we saw larger transactions, mainly driven by mega deal in the venture capital landscape, where startups are raising larger high-profile funding earlier in the funding cycle. So we expect 2022 to be another breaking record here in terms of deals. The metrics for the first half of year is already close to the annual level of last year, and we also expect, of course, the continuing growth of the venture capital activity.
All right, Nadia, let's get into how the regions compare, because looking at East Africa, West Africa, and Southern Africa, it's important to know where we're seeing this pool of investment coming through.
Sure. So from a regional perspective, West Africa continues to dominate private capital deals by volume, accumulating 35%, with Senegal holding the third place, overtaking Cote d'Ivoire, and to follow Nigeria and Ghana as having the largest share of the deal volume in the West Africa. But most interestingly is the East Africa experiencing the strongest growth, which was driven by a high number of investment in Kenya in particular. The early stage venture deals in financial and consumer discretionary, mainly online retailing, contributing significantly to this remarkable growth. And interestingly, East Africa, in terms of VC activity, has now surpassed North and Southern Africa. So yes, this is also not surprising from our perspective, since Kenya financial industry has been identified as a priority sector for the government Vision 2030 agenda, which aim at create a vibrant and globally competitive financial sectors. And so institutional and regulatory reform have been undertaken to attract more investors, local and international, alike to the sector.
All right, Nadia, let's look at what we're seeing in terms of the sectors that are getting this attention from investors. And when you separate the PE, the private equity and the venture capital space, are we looking at the same trends play out here in terms of the sectors that are attracting, or are we seeing other sectors play out more or less in terms of what we're seeing coming out from the VCs and their interest from the private equity?
Yes. Okay, great. Thank you. That's a good question. Even when we compare the traditional private equity and the VC, the trends are quite similar, with the main sectors maintaining momentum being the financial sector and also the industrial sector. And we have also seen some sector emerging from the margin. So talking about the sector that maintained momentum, so financial was the most active sector by volume, either in the private equity landscape or in the VC landscape. And this was mainly driven by fintech companies that continue to lead the growth of the financial sector, comprising almost 90% of the total number of deals within financial. So that also demonstrates that investors from all over the world always seek to capitalize on the enormous potential of the industry. Talking about the industrial in particular, that have also experienced remarkable growth in recent years, mainly driven by commercial and professional services along with transportation. So investors have been, let's say, increasingly attracted by opportunities within transportation, recognizing the vital role of the mobility in promoting Africa's economic and social development. So financial and industrial as the sector that maintain momentum in the private equity and venture capital landscape. Turning now to the sector that emerged from the margin, the first one is the healthcare. So again, across the different asset class, although healthcare typically account for a small proportion of VC deal volume each year, it remains a rising sector.
Meanwhile, Moodys says that the outlook for the banking sector in the West African Economic and Monetary Union region is stable, as the region's economy is expected to grow robustly. However, high food and energy prices could exacerbate socioeconomic and political risks. CNBC Africa's Kenneth Igbomo spoke to Mick Kabeya, a vice president and senior analyst at Moodys, to discuss the outlook in detail.
We have a stable outlook for the West African Economic Monetary Union for the next 12 to 18 months. And this is driven by drivers on both the operating environment side, but also the banking performance side. If we start with the operating environment side, we expect the economy to grow robustly, as you were saying earlier. This will be driven by continued structural reforms in the region, but also supportive monetary and fiscal policies, along with the economic program across the region. Additional benefits would come from the fact that there is an economic and monetary union in those 8 countries within the WAMU, which does support macroeconomic and currency stability. These trends that I just mentioned on the operating environment will help balance some of the challenges on the operating environments, including high inflation, particularly related to imported food and energy, which poses some risk on both the social and the political side, as well as some tail political risk that are related to recent coups in the region that also poses risk to the operating environment. But on balance, we have a stable view for the operating environments. And then just quickly on the bank's performance side, we expect the performance to be stable as well. This will reflect, on the one hand, the some modest asset quality weakening amid higher inflation, but that will be balanced by some slight improvements in the capital ratios, along with broad stability of profitability as well as funding and liquidity.
But I'd like to get into the issue of inflation and how you're assessing this challenge and more or less the policy response that we've seen. We saw that the Central Bank for West African states more or less hike rates for the second time in September, and how you see this both fiscal and monetary policies playing out here.
Sure. So inflation is primarily driven in the region, like in many other parts of Africa and of the world, is driven by imported food and energy, so higher prices on the imports of food and energy. The central bank, so the BCAO, which is the regional central bank, has raised interest rates twice already this year, 25 bips each time. So policy rates are now higher by 50 bips.
And a wrap on that conversation brings us to the end of Africa Business Weekly for this week. A big thanks to Tanya and Fiona for the regional updates. I'm David Alabi. We'll definitely be back same time next week for more weekly updates across the world of business in sub-Saharan Africa. Thanks for watching and bye for now.